Intangible assets with the finite life. We are going to cover these 5 topics in this unit. Intangible assets, impairment of finite lived intangible assets, purchase software and cloud computing arrangements, franchisee accounting, and finally the startup cost. Before we start, let's just have an idea what is an intangible asset. Of course, we know the basic understanding from our earlier studies tells us that the assets that do not have physical existence or physical substance are called intangible assets. But let's just go one step ahead. Intangible assets are your long-term rights, or call them long-term advantages that a business buys or a business develops. For example, you develop a design, you get it patented. So the patents you hold, the copyrights you hold, any franchise, we'll discuss it later, trademarks, all these are advantages, goodwill as well. So all these are long-term rights or advantages which you will benefit in the coming years. So these assets, they do not have physical substance. So that's why they're called intangible assets, and these assets are of course commonly tested in your CPA exam. Manner of acquisition. There are 2 ways to acquire intangible assets. One is purchase the intangible asset. Clearly, when a business buys an intangible asset from another business or another company or another person, it records it as an asset at its purchase price. Let's say I have purchased a patent paying $500,000, so simply a debit patent. Credit, cash and bank, it's very straightforward. So whatever you have paid, any legal cost, of course, any legal cost, registration fee paid to acquire this asset would also be included. Let's say talk about we paid 80,000. So the total of 580 would be debited to the cost of this intangible, right? So that is the first mod, purchase intangible. Second is internally developed intangible asset. Let's say you are a research company in a pharmaceutical business, and you have conducted a research, and this research resulted in some medicine formula which is a very promising future. So then you spend money to develop this into some viable product. So US GAAP says that all the research, all the development costs should be expensed. They are not made an asset, right? So such costs which are incurred in research phase as well as development phase, all these costs must be expensed. However, certain costs can be capitalized, like legal costs paid to get this patent registered, any legal consulting fee, any design cost for a trademark, for example. So direct cost to get this asset registered, any legal costs associated with that can be capitalized, but the research and development cost, that cannot be capitalized under the US GAAP. That is an important point to be remembered. Then those intangibles that can have a limited life and unlimited life. Limited life, like you got your patent registered with the Patent Registration Authority, and they have given you 10 years life, right? They have given you 10 years coverage. That is the legal life. So in that case, this 10 year is the life of the patent, so it's finite, it's limited. But certain assets, intangible, that have no specific time of expiry. Like let's say you've got a license which is renewable for a very small amount, maybe just $10 for renewal. So this license, which is renewed just for $10 for after every 5 years, it is an indefinite life. So you need to distinguish whether these assets, intangible assets from which we're going to get some benefit in the future, is it for the limited time period or is it indefinite? So that distinction is important, because accordingly we will either impair it if it's indefinite, and we will amortize it. Then another concept, the classification is separability, whether they are separable or inseparable. So first it was acquired or it was developed. Second, it had indefinite or definite life, and then separability. Certain intangibles are separable, like we have got the patent registered, we can sell them. Maybe we can sell copyrights, our franchises. So in that case, the patents, copyright, franchises, these are separable, right? But our own goodwill, our good name in the business, our trade name, it is inseparable. So certain intangibles are separable, and of course others are inseparable. So this distinction needs to be kept in mind. Capitalization of costs. Let's say now you have acquired an intangible asset from another enterprise. So what cost are you going to capitalize? Any amount that you have paid, or any fair value of the asset that you have transferred. Or maybe if you haven't paid any cash, or you haven't given any asset maybe you have acquired this asset in credit, so whatever liabilities you will pay in the future, so present value of those future liabilities, right? So either you take cash or fair value the asset, or in case if it's on credit, you will take the present value of the amounts to be paid for this intangible. So intangibles with definite finite life, 5 years, 10 years, 15 years, 20 years, it is amortized. Just like long-lived assets are depreciated, similarly, the intangible assets are amortized over its useful life, sometimes legal life, which are like, for example, you've got a patent, right? And its legal life is 10 years, but your marketing manager says it will hardly last 8 years. So whichever of these is lower, we will amortize this asset over the lower of these two, economic life or legal life, whichever is lower. So now the method you select, normally it's a straight line, but if you can use another method which you think is a better representation of the systematic charges to income statement, you may use accelerated depreciation, sum of year digits, or whatever method. We just have to allocate the depreciable base over the period of amortization. Method is totally your choice. Normally it's a straight line method, unless you have some suitable systematic method to use. Now if the life of the asset is either reduced or it is extended, let's say we have an asset with a remaining book value of $50,000, right? Now its life extends by another 5 years. So what we do, the remaining book value is now amortized over the new remaining life, whatever the life it might be. So it's just that whatever the remaining life is, as either let's say it's possible that the life has reduced to 3 years or it has gone up by 5 years. So whatever the extension is, remaining useful life, whatever it is, the book value is to be allocated over the new remaining life of the intangible. Sale of intangible asset. Okay, just take this number. We have the remaining life 5 or 3, whatever. The book value is important, 50,000. Now, if we sell this asset for $60,000, there is a $10,000 gain on disposal to be recorded on the income statement. And if we sell it for an amount lower than the carrying value, let's say $35,000, in that case, it's a loss on disposal, $15,000 to be reported in the income statement. So, sale of intangible asset could result in a gain or loss, and that gain and loss is reported as a part of your continuing operations and reported as a part of income statement. Valuation. How do we report an intangible asset? If your intangible asset has limited life or finite life, in that case, let's say if the original cost was $100,000, amortization charge so far, just like accumulated depreciation, we have accumulated amortization 20, and a payment loss, let's say $5,000, which is added eventually to the accumulated amortization. So this is the net carrying amount or the book value, right? If the intangible has a finite life. If it has indefinite life, in that case we report the original cost less any impairment. Let's say $30,000. So it's $70,000. This is the carrying value of the intangible with indefinite life. Okay, let's say you hold a patent with the carrying amount of, let's say, $70,000. And there are some reasons to believe that the value we have on our books of account, it is no longer recoverable. So this is what you call impairment. So there are two steps to impairment. The first step is you compare the future cash flows. Let's say this asset that is going to bring certain cash flow for the next 5 years, including its disposal value. So we add up all the undiscounted future cash flows, and it turns out to be $50,000. What is it? It is the sum of undiscounted future cash flows from this patent or this intangible, including its disposal value. Whatever it will bring this asset, it is total of 50,000 undiscounted. No discounting has been done. We compare this undiscounted future cash flows with the carrying amount, which I just told is 70. So this indicates, the first step tells that there is an impairment. In the second step, you compare this carrying value with the fair value. And let's say its fair value is, let's say it's 58,000. So this is the carrying value, this is the fair value. The 12,000 difference is the impairment loss to be charged, which is irreversible. Once you charge this impairment loss, it cannot be subsequently reversed. Now here is an important point. This loss cannot be subsequently reversed, but if this asset is specifically held for disposal. then it can be reversed. Let me give you a detailed example that will explain the idea. Here it is. So if you recall, we have done this earlier. It was a part of your long-lived assets impairment. So it's exactly the same. So undiscounted future net cash flows, let's say if it's, I'm taking new numbers, let's say it's $80,000 and your net carrying value is, let's say, $65,000. So your net carrying value is 65, undiscounted future cash flows is greater, bigger number, no impairment, do nothing. The issue comes here when your undiscounted future cash flows are 80, let's say, but your net carrying value is more. It's say, let's say 110. So clearly carrying value is more than the undiscounted future cash flow. So it's an indication of impairment. Now, if the asset is held for use, you will compare the carrying value, which is $110,000, with the fair value, which let's say is 90. The difference between these two is the impairment loss, which will result in writing down the asset by $20,000. This new 90,000 would be the new cost of the asset or new base to be used, and restoration not permitted. Any subsequent reversal in value in the market is not allowed to be incorporated in the books of accounts. Same thing, exactly the same thing as we have done in long-lived assets. Now, if the asset is held for disposal and fair value is 90,000, the carrying value is 110, so clearly there is an impairment loss of $20,000. And to it we have added 5,000 disposal costs, or total loss of $25,000 is charged. Total impairment is the impairment loss plus the cost of disposal, $25,000. So you do the same thing, write down asset, yes. No amortization taken is because this asset is to be disposed, so no more amortization. No new base gone from the books, but if it's still with you and if the value goes up subsequently, the previously written down loss can be reversed. So please remember, in case of asset held for use, restoration is not permitted, but in case if the asset is held for disposal, if the values go up, then you may restore the previously write-off amount. Assets net carrying value, book value is $900,000. Net future cash flows, just which you call the undiscounted future cash flows, it's more, whereas carrying value is less, so you do nothing. No impairment loss because the result is positive as per the previous flow. Now let's change things a bit. Net carrying value is 1.2 million, undiscounted future cash flows are 1 million, which means first step tells us there is an impairment. If the asset is held for use, in that case we'll compare the carrying value of 1.2 million with the fair value, and it says fair value $700,000. So it means the carrying value versus the fair value, this difference $500,000 will be impairment loss to be reported. Write asset down, amortize new cost will be $700,000. Restoration is not permitted. Now the second part, asset is held for disposal. In that case, carrying value versus fair value, this is $500,000 loss, impairment loss, and $100,000 is the cost of disposal given right here. Cost of disposal will be $1,000. So this is the total amount of loss you charge. Write the asset down, no amortization is taken, and restoration is permitted if the value goes up subsequently. Then the write-off, this $600,000 can be reversed. Purchase software and cloud computing arrangements. Let's first discuss the software that you acquired. Let's say if your company has acquired a software for its own use by spending $100,000, right? So we are going to record this amount as an intangible asset on the balance sheet for the amount we paid. And now, since it's an intangible asset, it needs to be amortized. Now, how are we going to amortize it, spread the cost over the certain period? There are two periods, let's say. One is the legal life, 10 years, let's say, as per the contractual terms, and one is the economic life, let's say 8 years. What is economic life? How long the software will be providing us the benefit. So we will select the shorter. So we will amortize this cost over the shorter of legal life or economic life. Since this is shorter, so we will spread $100,000 over 8 years. Next, we have cloud computing arrangements, or called CCA. So first of all, you need to know what is cloud computing. Like I'm using Microsoft 365, for which I pay $6 per month. Nearly, it's 6.99 basically. So this is what I pay on monthly basis. So when a company makes an arrangement with a vendor like this to use a software over the internet, and this software is of course hosted by the vendor Microsoft. Now there are three phases. Please see, this is an important part. So basically I gave you a very simple example of Microsoft 365, but large organizations do much more than that. So these are the three phases. First, the preliminary project phase, and let us be even more broader in our viewpoint. I'm not talking about just Microsoft 365. When I talk about the cloud computing, I'm talking about Amazon Web Services. I'm talking about Google Cloud. I'm talking about Microsoft Azure, right? So the first phase is the preliminary project phase. This is the phase involving the definition of what features we need. We discuss requirements with the vendor and assess if the software they're offering, will it serve our purpose, right? So this is the first phase of the project. Second, application development phase. In this phase, costs can be treated in two ways. Let me write this down. Those costs that are either added to the cost of the asset, which we call the capitalization, and second part of the cost are those that are expensed. Now, what cost do we capitalize? Cost like software licensing, fee paid to the third-party developer for customization, testing, any specific material used for implementation. All these are capitalized, added to the cost of the asset. And what costs are expensed? The costs that are for training our employees who would use these services, data entry operator, or any support cost for setting up the software. So capitalization should be clearly kept in mind. Software cost, licensing, fee paid for the third-party developer, customization, and just maintenance costs, just training our employees to work on it, and support costs, they are expensed. So once the system is in place, whatever this, maybe we were developing an inventory management system. So once it's in place, all the costs in these phases should be expensed. Like maybe we agreed to pay $2,000 for monthly maintenance fee, maybe $1,000 for periodic software updates. So these costs that we pay after the implementation phase, they are directly expensed to income statement. Byta Company contracts with Link Incorporated for a cloud computing arrangement for 5 years. Byta incurs the following cost: $2 million in determining system requirements, that is the preliminary project cost, goes right here, expense to the income statement. $8 million in implementation cost, that's the application development cost, that is capitalized as an asset. $1 million in manual data conversion, this is part of application development, but that is expensed, if you remember. Now, within application development phase, we have certain costs to be expensed, and this is one of them. Then we have $1 million in maintenance cost, it's post-implementation cost, it gets expensed to income statement. So this is income statement item, this one, and this one. $8 million is capitalized. The company will capitalize the $8 million in the implementation cost and amortize it over the 5 years hosting period. Assuming they use straight line amortization, the expense will be 8 upon 5, $1.6 million per year. The other cost, let me just specifically mark, determining the system requirement, this one, manual data conversion, this one, and maintenance cost, this one, will be expensed as incurred. Testing purchase software and capitalized cloud computing arrangements cost for impairment. Okay, let's continue with the previous amount. We had capitalized $8 million for a CCA arrangement. Now, this amount that we have on our books, it needs to be checked for impairment. We may have amortized it over the last few years. Let's say we decided that we will charge 1.6 million amortization every year. And let's say for 2 years we have charged 3.2 million. Which means our remaining book value is 4.8 million. That is at the end of the second year. Now we would like to test for impairment. Certain events have occurred which tell us that the amount we have is no longer recoverable. So what we do, we add up all the future cash flows expected from the software without discounting. Remember, undiscounted future cash flows. Let's say the number we get is 4 million. Now this is the undiscounted future cash flow sum. This is the carrying value. This is the first step which tells us that the asset is impaired. Right? The carrying amount 4.8 million. It is less than the undiscounted future cash flows. In the second step, we compare the carrying value with the fair value, and let's say the fair value is 3 million. So that means we need to write off 1.8 million loss to the income statement. Next, we have franchisee accounting. First of all, there are two parties. One is the franchisor, other is franchisee. So franchisor who sells franchise to franchisee. Let's say we talk about this. A is a franchisor. A and B enters into a franchise agreement whereby B would pay $50,000 upfront fee to open a franchise, and this is expected to last 10 years. Let's say this is the term of the franchise. Now this $50,000 received by A will be amortized over 10 years. So what happens? The franchisee pays upfront fee to the franchisor. This fee we receive as A as intangible asset recorded on the balance sheet, and then it is amortized over the expected life of the franchise. Right? Now, what about the continuing fee? B may be required to pay a certain fee which are continuing in nature. Like for example, B is required to pay a certain percentage of sales called franchise royalty. Maybe B has to pay for services of training, marketing and legal help. So B makes certain payments on an annual basis. So how do we treat it? Let's say in the first year, let's say sale was $100,000, and under the agreement B has to pay 5% of royalty, $5,000. So this $5,000 B pays its expense to B but income to A. Right? So all these items are discussed: training, marketing, legal. All these are the expenses for the franchisee, and for the franchisor they are all considered as revenue. So the important point to note is that all these payments are recorded as expenses in the period they incurred by the franchisee, and for the franchisor, the fee, the royalty that he receives, all these inflows, they are recorded as revenues in the same period. So this is the initial fee which we will amortize over 10 years, and this continuing fee we receive from franchisee, all these will be reported as revenues in the same period as they are booked by expenses by the franchisee. Peter signed an agreement on July 1st, year 1 with Disco Records to operate as a franchisee in New York City. The initial franchise fee was $75,000 and was paid by a $25,000 down payment, with the balance payable in the 5 equal annual payments of $10,000 beginning July 1st, year 2. The expected life of the franchise is 10 years. The present value of the 5 annual payments of $10,000 each to pay the balance $75,000 was total, $25,000 was paid, $50,000 remains, which is to be paid yearly by $10,000 every year. Okay, it says the expected life of the franchise is 10 years. The present value of the 5 annual payments is $37,908. The amount to be capitalized as an intangible franchise asset on July 1st, year 1 is $62,908. The amount paid at the present value of the future obligations, 5 payments of $10,000 each. So this is the intangible asset recorded by the franchisee. Prepare the journal entry to record the franchise on Peter's book, the franchisee. At the acquisition date, explain the accounting treatment required over the life of the franchise for the discount account, and calculate the amortization of the franchise's account for year 1. This $25,000 paid plus present value of the future obligations against franchise, this would be debited, $62,908, $25,000 paid to be credited, and the note payable for 5 $10,000 payments, $50,000 will be credited. The difference goes to discount account. Look at this: franchises debit, discount on notes payable, contra liability, notes payable $50,000 and cash $25,000. Then we have startup costs. Startup costs are the expenses incurred when establishing a new corporation or new activity, new business. These include organizational costs like legal fee. So such expenses should be expensed to income statement. Startup costs include cost of the one-time activity associated with, as I just told you, setting up a new business, new company, opening a new facility, launching a new product or service, expanding to a new location, or maybe serving a new type of customer, implementing new process or existing new facility, just like expenses of this nature. Setup costs do not include costs associated with, especially the costs associated with the regular ongoing improvement of current products, ongoing improvements to current services or facilities, costs associated to business mergers and acquisition, and cost for continuous customer acquisition effort. So just there is a comprehensive exhaustive list given on the textbook. Please just go through it. Important point here to note is that startup costs are meant to cover only the initial setup activities, not ongoing or routine expenses.